Good afternoon, everybody. This is Steve Janikowski with Brower & Janikowski. We recently held a client event, and since many of our clients live outside the area or were otherwise unable to attend the event, we've recorded the content from the client event into this webinar format. The topic was the international stock markets. Are they an opportunity or are they a hazard? Let's first take a look at what makes up the global stock markets. This pie chart represents all the global stock markets. The bottom gray slice, the United States, represents about 52% of the total global stock market. So the remaining 48% of the global markets are international. The purple slice, emerging markets, make up 11%. Continental Europe makes up 15%. The United Kingdom, or UK, is about 7%, and Japan is 8%, and there are a few other smaller slices. I often get questions from investors about investing in international stocks. The questions go something like this. Steve, the US market is doing extremely well, and the foreign markets, especially the emerging markets, aren't doing quite so well. Plus, it looks like there's a lot of trouble going on in many of the foreign countries. Is it really safe? And is it necessary to invest in international stocks? And after all, since the US makes up half of the total global stock market and the large multinational companies do business in foreign markets and including the emerging markets, so we're getting exposure to foreign markets through the multinationals domiciled in the US, is it really necessary to invest in foreign domiciled international stocks? Let's take a look at some of the things that we're following. They highlight some of the trouble spots and concerns that investors have about investing in international markets. First, there's a Greek default drama. This has been going on for over a decade and isn't likely to end soon. In fact, it's probably going to drag on for the next several years as the Greeks and the Europeans try to hash out a settlement. I'd call it a mini-series, except it's taking too long. It's really more of a soap opera with the back and forth between Europe and Greece and all the drama that's involved. The Ukraine-Russia conflict was one of the top news stories about a year or so ago. It's still going on. You just don't hear about it because there are other more pressing problems, but it's still going on. Then, of course, more recently, we have the trouble in China. The most visible sign of trouble in China is the crash of its stock markets. Here you can see a chart of the Shanghai Composite Index, which within about a month dropped almost 40%. Of course, the government jumped in, tried to manipulate and bolster the markets with a number of monetary measures, and it seems to have somewhat stabilized, but it's been very rocky, very volatile, which leads to the next problem, the slowdown in the Chinese economy. China used to be known as a tiger country based on the speed and of growth of its economy. And you can see that was true starting in 2000 all the way up to around 2007. The Chinese economy was growing very, very quickly. Since then, however, you've noticed that the Chinese economy has cooled down as a slowdown mode. It's still growing faster than most other global economies, but nonetheless, this is a problem for China, which is used to growing at a much quicker clip. And then there's Iran and negotiations to end their nuclear programs. Some are claiming victory with a nuclear non-proliferation treaty, but the reality is it's not a treaty yet because nothing's been agreed to. I thought the cover of The Economist, Hayatollah, was quite amusing. And if negotiations ultimately lead to a lifting of trade embargoes and sanctions against Iran, Iran will be free to sell its oil on the open market. Remember, Iran is one of the largest oil producers. We already have an oil glut. Iran would do nothing but add to an existing oil glut problem. And actually, the biggest contributor to the oil glut problem is probably the United States. With the ability to now access shale oil, a tremendous amount of oil has come on the open market. That, with the Saudi Arabians and other Middle Eastern countries with their spigots wide open, and couple that with Iran, the oil glut will continue to get worse, which will be problems for many of the countries that are exporters of oil. And of course, the glut in oil has led to a collapse in prices. This chart shows the volatility of the price of oil. And notice on the far right side of the chart in the red circle, the recent collapse that's happened over the last year. Oil has come down from about $114 a barrel down into the 40s. Currently, oil is trading somewhere around $45 a barrel. I've gone over a number of crises, but there are plenty more. The reality is there will always be crises. Go back in history. You won't find a time period when there haven't been some type of crises. It's not as though the world ever has been or ever will be a place of peaceful tranquility. And here's the good news. Crises and the perception of problems creates the investment opportunity for astute investors. When investors get nervous about an investment area that's undergoing a crisis or a problem, they sell indiscriminately, and that's what creates the opportunity. So let's get back to investing in international stocks. There are two reasons for investing internationally. One, diversification, and two, opportunities. Let's first talk about diversification. Earlier, we talked about how well the U.S. economy and the U.S. stock market were doing. And it's true, they have been doing very nicely. However, the economy appears to be slowing down. Well, in fact, it's been slow since the start of the recovery. In fact, it's been the slowest recovery on record, growing at about a 2% growth rate when we would have expected the economy to be growing somewhere around 4 to 5%. Now it's slowing even further than 2%. And on top of that, the stock market seems to have stalled out so far this year. So if all our investments are only in the U.S. and the U.S. starts to slide backwards and the stock market goes down, we have all our eggs in one basket. And while the U.S. economy and markets appear to be slowing down, other parts of the world are poised for recovery. I'm going to talk specifically about two areas, Europe and the emerging markets. Perhaps the biggest culprit in a slowdown of the U.S. economy is a strong U.S. dollar. Now, a strong dollar is a positive thing both politically and for many aspects of running the economy. However, there is a downside. A strong dollar hurts companies which export outside the U.S. because as the value of a dollar goes up, the cost of goods to foreign purchasers goes up dramatically, which means they'll buy less. And it means that U.S. exporters become less competitive. As U.S. exporters sell less, their earnings go down, which in turn hurts the stock market and also the overall growth rate of the U.S. economy. The flip side is true, however, which is a strong dollar means that foreign currencies are weaker. And if foreign currencies are weaker, foreign exporters selling into the U.S. are selling their goods at cheaper prices, which means they're more competitive, and it drives their earnings upward and improves their country's overall economic prospects. And this is exactly what we're beginning to see. European company earnings are accelerating, while U.S. company earnings are slowing down. Notice in this chart, on the far right side in the red circle, the purple line represents European company earnings. Notice that they've turned up so far this year. And at the same time, U.S. company earnings, represented by the gray line, have actually turned down this year. And ultimately, earnings drive stock prices, and stock prices drive stock markets. Let's take a look at how the European and the U.S. stock markets have performed over the last 6 years, coming out of the Great Recession of 2009. In the green circle on the far right of this chart, you can see the performance of the U.S. stock market, which is the blue line, or the S&P 500, and it's grown at a fairly robust clip. The red line represents European stocks, and it's also gone up, but not nearly as much as the U.S. stock market. Now, why is that? Well, several reasons. One, the U.S. economy has been stronger, company earnings have been much more robust, and most importantly, Our Federal Reserve, starting back in 2009, has been on an aggressive monetary stimulus program which has driven asset values, meaning stocks and real estate. Now, looking at Europe from 2009, their economy and company earnings have been fairly lackluster, and their central bank has not actually undergone any type of monetary stimulus program driving asset values as the U.S. central bank has. That's beginning to change. The European Central Bank has most recently begun a more aggressive program of monetary stimulus. If we take a look at the relative valuations of U.S. stocks to foreign stocks, this chart is actually very interesting. This chart shows the ratio of the value of foreign stocks to U.S. stocks. The red line represents the average for a long period of time. And whenever the line is above the red line, that's the blue line, which represents this ratio of foreign stocks to U.S. stock valuation, it means that foreign stocks are expensive. Whenever that blue line is below the red line, it means that foreign stocks are cheap relative to U.S. stocks. Well, you can see that foreign stocks have been cheap relative to U.S. stocks for quite a number of years now, but that has intensified over the last several years. I mentioned that monetary stimulus by the central bank, our Federal Reserve, drove asset prices, that is U.S. stocks and U.S. real estate. Well, that worked in Japan as well. Monetary stimulus, including a program called quantitative easing, QE, has been an elixir for asset prices. Stock markets and real estate markets in the U.S. and Japan have skyrocketed over the last 6 years. Here you can see how quantitative easing, or QE, which is the largest component of monetary stimulus from the Federal Reserve, drove the U.S. stock market. The blue line in this chart shows the increase in monetary stimulus, and the black line is the U.S. stock market. I've drawn a red arrow to indicate the direction, and notice that the stock market has gone in almost lockstep with the rise in monetary stimulus. Europe has finally started its own version of monetary stimulus and quantitative easing just this year. We know it's worked in the US and it's worked in Japan. The question is, will it work for Europe? Well, the answer in a word, yes, it has. While the US market has gone virtually nowhere so far in 2015, European stocks have gone up quite a bit. Most of them are in double-digit returns so far this year. The other area of opportunity I wanted to discuss is in the emerging markets. The emerging markets have actually been quite poor performers over the last several years and horrible performance so far this year. Nonetheless, we do believe that they are poised for recovery. Hence, I drew this picture of a spring ready to be sprung. Let's take a look at some of the attributes of emerging markets that make them attractive. First of all, emerging markets have the fastest growing middle class. We can see that represented in this chart on consumption. The purple line shows EM, or emerging market consumption, as a percentage of the total global consumption. And notice over the last decade, that's been going up. Whereas the gray line shows U.S. consumption as a percentage of the total global consumption. And that line has been going down. Well, emerging market consumption is going up because of the growth rate of their middle class. They're buying more. And it's not that U.S. consumption is actually going down, it's just not going up as quickly as the emerging markets, and therefore, on a relative basis, it's declining. Not only is the growth of their middle class driving consumption, it's also driving the growth rate of these emerging economies. This chart's interesting because it shows the relative growth rate of emerging markets relative to developed markets. The gray line shows the growth rate of emerging markets, and the blue line shows the growth rate of developed markets such as the United States and Europe. Notice there's a pretty big gap between the two. In the red circle on the right, notice that The developed markets have been growing at about a 2% growth rate, whereas emerging markets have been growing somewhere close to a 5% growth rate. Now, quickly growing economies don't translate automatically into fast rising stock markets. This chart's interesting, however, because it covers the two major drivers of stock prices and stock markets: earnings growth rates and valuations. The top chart represents valuations, or PEs, which is short for price to earnings multiples. Now, what does that mean? Well, if you take the price of a stock or a stock market and divide it by the earnings, you're going to come up with a ratio. That ratio is useful because you can compare that then to either another stock or a stock market to a different stock market. The higher the number, the more expensive that stock or stock market. The lower the number, the cheaper the stock or the stock market. Ideally, we'd like to see cheaper prices. Now here we can see in this top chart the valuations of developed markets, which is the blue line, versus emerging markets, which is the gray line. So in the circle on the red circle on the far right, you can see that developed markets have a price to earnings multiple of 17.4, whereas the emerging markets have a price to earnings multiple of about 12.9. So clearly, developed markets are trading at a much higher, or they're more expensive valuation than emerging markets. Now let's look at earnings growth rate. Earnings growth rates is very interesting because we're really looking at how quickly companies and the underlying companies in a stock market are growing. Ideally, you like to see more quickly growing companies. So again, the blue line represents developed countries, and the gray line represents emerging markets. The gray line shows that emerging markets have an earnings growth rate of approximately 13.2%, whereas developed markets have an earnings growth rate of 10.8%. So here we see that emerging markets have earnings growth rates that are growing much faster than developed markets. Ideally, you'd like to find cheaper prices with faster earnings growth rates, which is exactly what we see emerging markets sporting right now. Smells like an opportunity. We focused on investing in international stocks in this webinar. We talked about the merits of diversification as well as some of the opportunities outside the U.S. and foreign markets and emerging markets. And we hope we made a compelling case as to why it makes sense to have international stocks in your portfolio. While we're not going to spend much time in this webinar, I did want to just briefly touch on two other areas outside of international stocks that we find very interesting right now. One is real estate, and the other one is energy infrastructure. As the fear of rising interest rates has permeated, and the concern that the Fed Reserve is going to raise rates, it's hurt anything that's what we'd call interest rate sensitive, bonds and dividend yielding stocks. The higher the dividend yield, the more it's impacted that investment. Those two areas that have been impacted quite a bit are real estate investment trusts, or REITs, which are high dividend yielding real estate investments. And the second one is energy infrastructure, which also sports a very high current yield. We find the valuations in real estate to still be quite compelling and the dividend yield to be really quite attractive, and so we're big fans of real estate investment trusts, and you have some in your portfolio. Energy infrastructure is very compelling. Even though we discussed earlier in this webinar the glut in oil prices, or oil, and how oil prices have gone down, this has hurt the overall oil industry. However, in our view, this doesn't have a big impact on energy infrastructure, because energy infrastructure is not about exploring oil, it's about processing and transporting oil. So it doesn't have the risk, the commodity risk of the price of commodities, as does exploratory or the integrated oil companies have. And really, we like to think of it as they have long-term contracts where they've signed with customers who want to transport oil, natural gas, or natural gas liquids. And that's not going to change dramatically in our view just because oil prices have gone down. So the recent drop in prices we view as an opportunity, and the yields have gotten even juicier as a result of the drop prices. And you'll be hearing more about this in emails and other correspondence in the future. So anyway, we just wanted to thank you for taking the time to listen to this webinar and hope it was helpful and useful. And if you have any questions, feel free to call your financial advisor and they'd be happy to spend more time in detail on any of the areas I've covered in this webinar. And we hope to see you at a future client event. Thanks again for listening and have a great evening. Take care. Bye-bye.